There are many trading courses available, each with their own strengths and areas of focus. A comprehensive trading course should cover the following topics. Basic trading concepts. A good trading course should cover the basic concepts of trading, including terminology, types of trading, and the different markets and instruments available. Fundamental analysis. Fundamental analysis is the study of economic, financial, and other qualitative and quantitative factors to evaluate the value of an asset or market. A comprehensive trading course should cover this topic in detail. Earnings per share, EPS. The amount of earnings per share is an important metric for assessing a company's profitability. Price-to-earnings ratio, P/E ratio. This ratio is used to compare a company's current stock price to its earnings per share, and is an important indicator of how much investors are willing to pay for a company's stock. Price-to-book ratio, P/B ratio. This ratio is used to compare a company's current stock price to its book value, the value of its assets minus its liabilities, and is an important indicator of a company's valuation. Debt-to-equity ratio, D/E ratio. This ratio is used to measure a company's debt relative to its equity, and is an important indicator of a company's financial health. Fundamental analysis is a method of evaluating the intrinsic value of an asset by analyzing the economic and financial factors that affect its price. In the context of trading, fundamental analysis can be applied to various asset classes, including stocks, bonds, currencies, and commodities. The goal of fundamental analysis in trading is to identify assets that are either undervalued or overvalued relative to their intrinsic value. To do this, traders need to analyze various factors that can affect the asset's price, including economic indicators. Economic indicators such as GDP, inflation rates, and employment data can provide insights into the health of the economy, which can in turn affect the price of assets. Company financials. For stocks, fundamental analysis involves analyzing a company's financial statements to determine its profitability, earnings, and cash flow. For bonds, fundamental analysis involves analyzing the issuer's financial health and creditworthiness. Industry trends. Industry-specific factors such as technological advancements, regulatory changes, and competition can also affect the price of assets. Geopolitical events. Political and social events such as wars, elections, and natural disasters can also have an impact on the price of assets. After analyzing these factors, traders can use various valuation models to determine whether an asset is undervalued or overvalued. Some common valuation models used in fundamental analysis include the discounted cash flow model, the price-to-earnings ratio, and the price-to-book ratio. Overall, fundamental analysis is an important tool for traders who want to make informed investment decisions. By analyzing the economic and financial factors that affect an asset's price, traders can identify opportunities to buy undervalued assets and sell overvalued ones, potentially earning a profit. Technical analysis. Technical analysis is the study of price charts and other market data to identify patterns and trends that can help predict future price movements. This is an essential topic for any trading course. Technical analysis is a method of evaluating the price and volume data of an asset to identify patterns and trends that can be used to make trading decisions. In the context of trading, technical analysis is typically applied to stocks, currencies, commodities, and other financial instruments. The goal of technical analysis is to identify patterns in an asset's price and volume data that can provide insights into its future price movements. Some of the key indicators used in technical analysis include moving averages. Moving averages are used to smooth out the price data of an asset and identify its overall trend. They are calculated by taking the average price of an asset over a specified time period. Relative Strength Index, RSI. The RSI is used to identify overbought and oversold conditions in an asset. It compares the average gains and losses of an asset over a specified time period to determine whether it is overbought or oversold. Bollinger Bands. Bollinger Bands are used to identify the volatility of an asset. They are calculated by creating two standard deviation bands around a moving average of the asset's price data. Fibonacci retracements. Fibonacci retracements are used to identify potential levels of support and resistance in an asset's price. They are calculated by dividing the vertical distance between two price points by key Fibonacci ratios. Traders who use technical analysis typically use charts to visualize an asset's price and volume data. They may use different chart types, such as candlestick charts or line charts, to identify patterns and trends in the data. Overall, technical analysis is an important tool for traders who want to make informed trading decisions. By analyzing an asset's price and volume data, traders can identify potential opportunities to buy or sell an asset and potentially earn a profit. However, it is important to note that technical analysis is not foolproof and can be subject to interpretation and false signals. Risk management. Risk management is an important part of trading and involves strategies to manage and minimize potential losses. A good trading course should cover various risk management techniques and the importance of discipline. Risk management is a crucial aspect of trading that involves identifying, evaluating, and mitigating potential risks that could result in financial losses. Effective risk management strategies can help traders protect their capital, minimize losses, and maximize potential profits. Here are some key principles of trading risk management. Determine risk tolerance. Before entering any trades, traders should establish their risk tolerance and develop a clear understanding of their financial goals. This can help them make informed trading decisions and avoid taking excessive risks. Use stop losses. A stop loss is a predetermined price level at which a trader will exit a trade to limit potential losses. Traders can set stop losses based on their risk tolerance and market conditions. Implement proper position sizing. Position sizing involves determining the appropriate amount of capital to allocate to a specific trade based on the trader's risk tolerance, account size, and market conditions. Diversify your portfolio. Diversification involves spreading out your investments across multiple assets, which can help reduce overall portfolio risk. Monitor market conditions. Traders should regularly monitor market conditions and adjust their trading strategies accordingly. This can help them avoid taking unnecessary risks and capitalize on potential opportunities. Use risk-reward ratios. Risk-reward ratios are used to evaluate potential trades by comparing the potential profit to the potential loss. Traders should look for trades with a positive risk-reward ratio, where the potential profit outweighs the potential loss. Trading psychology. Trading psychology is an often overlooked aspect of trading, but it is critical for success. A comprehensive trading course should cover topics such as emotions, mindset, discipline, and self-awareness. Trading psychology is the study of the emotional and mental factors that can impact a trader's decision-making process. Successful traders recognize that emotions such as fear, greed, and hope can all influence their trading decisions and can have a significant impact on their overall trading performance. Here are some key principles of trading psychology. Control emotions. One of the most important aspects of trading psychology is learning to control emotions. Traders need to be able to remain calm and objective in the face of market volatility and not let emotions such as fear or greed cloud their judgment. Develop a trading plan. A well-defined trading plan can help traders avoid making impulsive decisions based on emotions. It should include entry and exit points, risk management strategies, and a clear understanding of the trader's financial goals. Avoid overtrading. Overtrading can be a common mistake among traders, and it can be caused by emotions such as greed or fear of missing out. Successful traders recognize when it's time to step back and wait for the right opportunities. Learn from mistakes. No trader is perfect, and everyone makes mistakes. Successful traders learn from their mistakes and use them as opportunities to improve their trading strategies and decision-making process. Manage risk. Risk management is a critical aspect of trading psychology. Traders need to be able to manage their risk exposure to avoid significant losses that could impact their overall financial goals. Stay disciplined. Consistency and discipline are essential for successful trading. Traders should have a clear set of rules and strategies that they follow consistently, regardless of market conditions. Trading strategies. A good trading course should teach various trading strategies, such as day trading, swing trading, and position trading, and how to apply them in different market conditions. Trading strategies are a set of rules and guidelines that traders use to make buying and selling decisions. There are many different trading strategies, and each one has its own strengths and weaknesses. Here are some of the most common trading strategies used by traders. Trend following. Trend following strategies involve identifying the direction of the market trend and trading in the same direction. These strategies can be used with various technical indicators, such as moving averages or trend line.